Hello friends, I'm Satish Kumar back with you for the discussion on the subject income from capital gains. In the previous video, we had discussed meaning of capital gains and also meaning of transfer. In this video, let us examine meaning of the term capital asset. It's because it is the sale of capital asset that results in capital gains. Now, Income Tax Act defines the term capital asset in section 2 subsection 14. This is an inclusive definition and not an exhaustive definition. Here it says property of any kind. That means virtually every asset is treated as a capital asset. Now whether this asset is related to business or not. Now this word business or not has been included for the reason that there may be a confusion as to when a business asset is sold whether it should be income from business or a capital gain. So by insertion of these words, it means that even if a business asset is sold, a capital gain can arise. Section also says that any securities held by foreign institutional investors would be treated as capital asset if they are held in accordance with the guidelines issued by SEBI. Now first section said property of any kind. That means every asset is brought in within the definition of capital asset. Then later on section proceeds to exclude certain assets from the definition of capital asset like stock in trade or consumable stores like stationery or raw material. If these assets are held for the purpose of business, then they will not be treated as capital asset. In other words, sale of these assets would result in income from business and not income from capital gains. Then personal effects. Agricultural lands. Now meaning of these term personal effect or agricultural lands we'll examine in the subsequent slides. And bonds issued by central government like gold bonds or special bearer bonds or gold deposit bonds, etc. Now, what is the meaning of the term personal effect? Because this is the item of asset which is excluded from the definition of capital asset. Now, a personal effect is any movable property, whether it is wearing apparel, furniture, whatever it is, and if it is held for personal use of either the taxpayer or any of his dependent family member. If any asset is a movable asset, and it is held for the personal use of the taxpayer or his dependent family member, it will be treated as personal effect. Now, any asset which is treated as personal asset is sold, then it will not give rise to capital gain. That means suppose I have a piece of furniture and I sell it, I will not be liable for income from capital gains. But the Act also provides certain exclusion to exclusion. That means whatever the assets what we are going to discuss now will not be treated as personal asset even though they are movable assets and held for personal use. That means if these assets are sold, capital gains are attracted. Like jewelry, drawings, paintings, archaeological collections, sculptures, work of any art. Perhaps any of these items, when they are sold, they fetch exorbitant price. For this reason, they are excluded from the definition of personal effect. Now, let's know what is the meaning of this term jewelry. The Act says, again here this is an inclusive definition, it says jewelry includes any ornament made of gold, silver, platinum or any other precious metal. Now what's a precious metal? Act doesn't define, but if you look at International Organization of Standardization, it has given the status of currency to 4 metals like gold, silver, platinum and palladium. So technically these are the 4 precious metals, but then the meaning of the term is very subjective and also dynamic. So it can depends on the facts of the cases. Okay. So if any ornament made of such metal or any alloy containing such precious metal will also be treated as jewelry. Now, such ornament may or may not contain any precious stone or a semi-precious stone, like whether such precious stone are sewn into any wearing apparel or embedded in any furniture, etc. So all this would be treated as jewelry. In other words, suppose any precious metal or precious stones are embedded in any utensil or furniture, so they will be treated as jewelry, and sale of such asset would attract income from capital gains. Next, I said agricultural lands are excluded from the definition of capital asset. Now, what is the meaning of agricultural land? Strictly speaking, any land on which agricultural operations are carried on are to be treated as agricultural lands. But what about urban agricultural land? Now, with reference to this, Income Tax Act says that following types of lands will not be treated as agricultural lands. That is, if the land is situated in any town, municipality, cantonment, or whatever name you call it, and population of that municipality, etc., is more than 10,000, then such land will be an urban land and it will not be treated as agricultural land. Suppose land is situated outside the municipal limits, then what happens? If the land is situated within a distance of 2 kilometers from the municipal limits and population of that municipality is between 10,000 and 1 lakh, again, such land will not be treated as agricultural land. Similarly, when the land is situated within a distance of 6 kilometers and population of the municipality is between 1 lakh and 10 lakhs, or where the land is situated within a distance of 8 kilometers from the municipal limits and population of that municipality exceeds 10 lakh, then such land will not be treated as agricultural land. Earlier, there used to be a dispute as to how do I measure the distance, this 2, 6 or 8 kilometers. Is it as the road goes or is it the shortest route? Suppose there is a walking path, how do I take it? Now the Act has been amended to say that distance is to be measured as crow flies. Now, practically, it's a different matter as to how do you measure the land as a crow flies. It's a different matter, probably left to the judges to decide. But anyway, the Act says that the distance should be measured as crow flies. Coming to this population, as on what date the population is to be seen? Is it on the date of sale or date of filing the return or date of the first day of the assessment year? This confusion can arise. So Act says that population is as per the preceding census, that is the latest census, figures of which are available before the first day of the previous year. That means, for example, the assessment year is 2020-21 and previous year would be 2019-20. Now the figures should be available before the first day of the previous year. That means first day of the previous year would be 1st April 2019. Before that, that means at least by 31st March 2019, the figures should be available. And such figures will be considered for the purpose of population. Now, tax purposes, all these capital assets are divided or classified into two types. That is a short-term capital asset and a long-term capital asset. Now, the type of the asset decides the rate of taxation. If the asset is a long-term capital asset, the rate of tax would be 20% flat. Whereas if the asset sold is a short-term capital asset, the gains would be included with the other regular income of the taxpayer, and whatever the rate that is applicable to that total income would be applied. Now, again, another benefit for long-term capital asset would be that they are entitled for certain exemptions that we would of course see in this latest videos. Now, coming to the Income Tax Act, definition of long-term capital asset is very simple. It says any asset which is not a short-term capital asset. This is the definition given in section 2 subsection 29A. Now, coming to short-term capital asset, any asset which is held for a period less than 12 months if it is a listed security. That means shares, etc., if they are listed with stock exchange and held for a period of less than 12 months, it will be treated as short-term capital asset. And in the case of unlisted securities, period of holding is 24 months. And similarly, land or building also period of holding is 24 months. If it is held for less than this period, it will be short-term capital asset. And if it's held for more period, it will be long-term capital asset. As far as land and building, earlier it used to be 36 months. Now with effect from assessment year 2018-19, the period is brought down to 24 months. Now, how do you reckon this period of holding? Especially when I receive a gift or say inherit a property. Okay. And why is it important? Because that decides the nature of the gain, that is whether long-term or short-term capital gain. Suppose if I receive gift under or a will or inheritance, etc., then the act says that the period of holding of the previous owner also should be considered. That means, for example, now I receive a gift of a building from my father. I sell it after 12 months. So is it a long-term asset or a short-term capital asset? Now, the Act says the period of holding of the previous owner, that's my father, also should be considered. Suppose he was holding the building for a period of more than 12 months. Say, for example, he was holding it for, say, 15 months. So 15 months plus a period of 12 months that I was holding would be in excess of 24 months. So this would be a long-term capital asset in my hand and would be taxed accordingly. Thank you, friends. In case you have any queries on what we have discussed today, please leave a comment. Thank you.